Hey everyone, this is Kirk here again at OptionAlpha.com. Welcome back to the video update where we go over all of our trades that we made here today on the platform, both opening and closing or adjusting trades. And tonight we got a fairly good video, a lot of trades we made today. We made 3 new opening trades and closed out 3 profitable trades as well. So very good end to the week here to kind of kick off the first half trading week of the year. And we'll go over each of these. Again, as a reminder for all of those of you who are out there watching this on YouTube, on public, the video, you don't actually see this video until 5 days after it's posted just for our members on the OptionAlpha.com platform. So again, this goes out to our members first. They get to see it for 5 days so that you can take advantage of the trade alerts that we make here. So just sign up at OptionAlpha.com and you'll see not only the trade alerts, but this video each and every night. So let's go over, like I said, the closing alerts that we had here for today. And I want to kind of go through these fairly quickly. But again, I'll jump back and forth between this screen and the actual screen of the stock that we actually talked about. The first one that we did is we closed out our put spread that we had on MA, which is MasterCard. Now, originally we had sold the 770, 765 put spread. And we went ahead and went back in and bought it back today for a 15-cent debit. Now, ideally, again, we could have waited because their January expiration. We could have waited, and this probably would have expired worthless in January. And I'll show you the chart here in a little bit. But for 15 more cents and about 17 days to go left in the expiration cycle, it wasn't worth letting this trade on so that MasterCard could possibly turn around and create a loss. So we made $95 on this trade. So we made a very healthy profit on this. We made the vast majority of the profit that we could potentially make selling a credit spread. So we went ahead again and went back in there and bought the spread back. So let's take a look at MasterCard and you can see exactly what happened. And this is, again, just really kind of luck on our end that we sold the put spread versus the call spread. But you'll notice that implied volatility is still very, very high on MasterCard. So it still looks like a good opportunity to trade. And we'll definitely be looking at some new trades for MasterCard next week with 83 percentile volatility. But you can see that our put spread, which was below the market, kind of right in this range right here, took really advantage of MasterCard just continuing to move higher with the broad market. And that was our whole idea going forward with this trade, is that we want to get some more positive delta in our portfolio. So again, just took advantage of that. We don't want MasterCard to turn around and kind of flip over near expiration. Second trade we want to talk about is we sold our vertical call spread. This is one that we actually entered for a debit. Around 260 is what we actually entered this one for, and that was the Walmart 75-78 call spread. So we had originally bought the 75 calls, sold the 80 calls, which were just out of the money to help finance them, and we paid around 260 for this, and then we sold it back to the market today for 365. Now again, you go back through some of the archive videos, the whole idea with this debit call spread, because we weren't selling premium, but we were actually just buying an option spread, was that our bet was that sometime between now and January expiration, or now meaning the time we entered the trade, between the time we entered the trade and January expiration, that Walmart would at some point trade higher and we'd have an opportunity to take a profit. And so again, that's all we wanted to do on this trade. And so you can see that that's exactly what happened, is that we kind of entered the spread back around here when it was kind of making its lows. And we just said, hey, you know what? And I'll cut off this chart because this is about where we entered the trade and this is all we kind of saw. As we said, you know what? Given how much Walmart has sold off, we're going to make a bet that sometime between now and expiration that Walmart is going to make a little bit more of a rebound and move higher. And you can see it's exactly what it did. So now that it made the move that we were kind of expecting it to make, we're not going to get greedy here and try to get the full $5 profit out of this. So we took money off the table. What originally is a 50-50 bet, statistically, we now take off the table and make that and put that, tack it into our winning column. So that's what we did with that trade, and that's what you really should do with a lot of these debit put spreads. As soon as you see a nice healthy profit, take some money off the table. We made $105 per spread, so it was a very, very healthy profit. All right, so the last closing alert that we had here today was, again, another vertical call spread that we bought back for a debit, and that was the EWW 7071 call spread that we had originally sold. We had sold it for 30 cents. Each spread we sold for 30 cents. We sold 5 of them, and we made a $25 profit per spread. So again, very healthy profit. We bought it back for 5 cents. There's no point in letting this thing ride all the way to expiration. Again, even though it could be options that expire completely worthless, there's no point in letting EWW turn around sometime here in the next 17 days and hit our positions again. So we had a nice move down in the stock. We had a great move down in volatility. We sold this call spread clearly when it was above the 50th percentile. Now it's back down below 50. And again, you notice that our strikes are way above the market. They're not even on the chart here. So as EWW continued to move down, that really helped our position and helped this decay in premium happen a lot quicker. So let's not get greedy here. There's definitely room. You can see how quickly it moves. This stock can come right back up and go right against our strikes in the next 17 days. So we don't want that to happen, and that's why we're just closing out the trade right now with a nice little profit. All right, so let's talk about the new trades that we opened here today. The first one that we opened is a vertical call spread on USO. Now, oil's been killed lately, and again, I'll go to the actual chart here and we'll take a look at that. But we actually entered the 33.35 call spread, and again, it's a $2 wide spread. We paid a debit for it, and if you follow the trading alerts that we have here, when we usually enter a debit put spread or a debit call spread, we like to enter that trade with paying about half the width of the strikes. So the width of the strikes here are $2, 33 to 35, and we paid almost about that, about $1.05 in price. So again, since it's a debit spread that we're entering on USO, we only want USO just to trade higher anytime between now and February expiration. So here's a chart of oil. You can see it's been killed the last couple of days here, and as it continues to move lower, all we're saying is that at some point between now and February expiration, which is this red line here on my chart, I have it just up here so I know exactly where it is, I think that at some point oil is going to trade a little bit higher. We're going to have a little bit more of a rebound in oil, maybe not right away, but at some point it's going to trade higher than it is today. And that's all we're betting on. It's a 50-50 bet for now, but we're going to take money off the table when we get that opportunity. And I think we'll definitely get that opportunity here in the next couple weeks. If we actually go to the actual chart or the trade tab of oil, I want you guys to take a look at where we entered the strikes with these vertical call spreads. So again, you can see where our position is, the 33 and the 35, and you notice that the 33 is just in the money and the 35 is just out of the money. So we sold an option that has no intrinsic value, has all extrinsic value, so that helps with our position, and we bought an option that actually has intrinsic value. So it's a little bit different way of doing it. Not a lot of people do this when they buy vertical call spreads or put spreads, but we typically like to buy the option that's in the money and sell an option right out of the money. Again, kind of straddling the market with our strikes here. So, and oil is at 33.75, so 33 and 35 is about a good distance away on either end from the market. So making a nice straddle of the market. All right, so the next one that we entered was the vertical call spread on DIS, which is Disney. We sold the 77.580 call spread, and we sold it for 90 cents. It's a pretty good premium for that type of trade. And again, we'll take a look at the actual chart here of Disney, but Disney's been on a tear, and so we think that at some point it might come back down. Oh, that's DIA. So this is Disney. Disney's been moving up very nicely. So any of you who have Disney stock, you're obviously very happy, but because it's been moving up at such a rapid pace here over the last couple of weeks, we think there's a good likelihood that at some point, again, between now and February expiration, we're giving ourselves lots of time here to be right on this trade, that Disney's going to make a move back down. So that's what we're betting here, is that we're selling the call spread above the market. And the reason we're selling the call spread and not buying a put spread is because implied volatility is at the 63rd percentile. So it's above that magic 50th percentile that we're looking for. So it's on the high end of the range. And because it's on the high end of the range, we know that we have an opportunity to then sell premium at some point or somewhere in the market. If we go to the actual trade tab of Disney and take a look at where our position is, here it is again, February expiration. You can see that our position is kind of just out of the money on the trade tab. The next strike out of the money is the 77.5, which is where we're at right here. And you can see the probability that it gets out there is around 35% based on where our break-even point is. So we have a very good probability of success. It's about a 65-68% probability of success that we have on this trade. So it's not likely that Disney's going to get out there, but again, if it does, we have volatility on our side, right? We're selling high premium. So even if Disney continues to move higher but volatility contracts, we probably could make some money on this trade as well. So that's what we'll look to do, is look to buy back this spread at some point between now and February expiration, probably around 15 cents or so, somewhere in that neighborhood, similar to what we did down here with EWW and MA. All right, so the last trade we put on here today is we sold a vertical put spread in Twitter. Now, we already have a position on both put spread and call spread on Twitter for January expiration, so this is actually moving out to February. And really, this is just a matter of Twitter being so high in implied volatility that it's kind of hard to ignore at this point. Twitter is one of those ones that's been really, really high with implied volatility the last week or so. And so you just can't ignore it. You got to put on these trades, and you got to keep going back to the well with high implied volatility. So what we did here is we sold the 55.50 put spread. Again, sold the 55s, bought the 50s to help finance that sale, and we sold it for $1.40 credit. So let's take a look at where Twitter is now. We've got a lot of room. Twitter implied volatility is extremely high right now. I think the last time we checked, yeah, it was above 90. So you can see Twitter continues to move up. It's had one heck of a time bouncing between 76 and 60, which is a huge swing for a stock. But our strikes are down here at 55 and below, so we do have some good distance between ourselves and the market, and it seems like the market wants Twitter to go higher, right? I mean, this is a huge name, huge IPO, and it seems like Twitter's just kind of catching fire here. So in that case, we chose to go with the put spread instead of the call spread, even though it looks a little toppy to me, and just hoping that the market's going to continue to fuel this rally in Twitter here. And that's going to obviously help our position tremendously, as well as hopefully a decline in implied volatility. So you'll notice up here in the top left-hand corner that implied volatility is at the 91 percentile. So what that means is that 91% of the time, implied volatility is never this high, right? So it's extremely high right now, which means that option premiums have swelled across the board. And that really helps our position. That helps us get down below the market in a significant manner, give ourselves room between us and the market. So again, hopefully you guys enjoy these videos. Have a great weekend. If you have any comments or questions, please add them below to the video. I'll definitely get back to everyone this weekend. Happy trading.